Today, we are diving deep into a stock that is, well, a complete paradox. We're talking about PG&E. And really, it's a story of two totally different investments mashed into one company. On one side, you've got this rock-solid, regulated monopoly, and on the other, a super high-stakes bet on whether politicians are going to change a law.
So which is it? That's the million-dollar question we're going to tackle. Is PG&E a safe, almost boringly predictable utility stock, or is it a high-risk gamble that could pay off in a massive way? Stick with me, because by the end of this, you'll get a crystal clear picture of why the market just can't seem to make up its mind.
All right, here's our game plan. First, we'll look at the good stuff, the company's untouchable monopoly. Then, we'll get into the big, glaring flaw, the thing that keeps investors up at night. After that, we'll explore what could change the entire story, including a pretty surprising growth driver from an unexpected place. And then, we'll wrap it all up with a final verdict.
Okay, so let's kick things off with the bull case, the foundation of this company. The core strength of PG&E isn't some fancy new tech or a cool brand. Nope, it's much simpler. It's all about geography and the law.
I mean, just look at the scale of this thing. We're talking about millions and millions of customers spread out over a territory of 70,000 square miles. There's just no way, absolutely no way, someone could come in and build a competing network. It's the definition of a natural monopoly, giving it this incredible competitive moat that basically guarantees its business forever. And this is where things get really interesting. That monopoly power gets a massive boost from state policy. You see, California has mandated this huge transition to clean energy, and guess who's been tasked with building it? PG&E. That means they have a guaranteed state-mandated spending plan of $73 billion over the next 5 years. Now, that $73 billion isn't just money going out the door, it's practically a pre-approved growth plan. See, for a regulated utility, every dollar they invest in the grid, things like power lines and substations, gets added to what's called their rate base. And regulators let them earn a guaranteed profit on that rate base. So this spending automatically translates to predictable earnings growth, whether the economy is booming or busting. All right, if the story is so great, why isn't everyone piling into this stock? What's the catch? Well, that brings us to the big, scary flaw. There is a giant risk, a real sword of Damocles hanging right over this company. And it all comes down to two things: wildfires and a very strange legal rule. Okay, lean in for this one, because this is the key to the whole puzzle. It's called inverse condemnation. And what it means is that if PG&E's equipment is involved in a wildfire, they are 100% liable for all the damages. Period. It doesn't matter if they followed every safety rule in the book. If it's their gear, it's their bill. This one rule transforms the company from a simple utility into something that acts more like a risky catastrophe bond. And you can literally see this risk priced into the stock. The market values PG&E's future earnings at a forward PE of just under 10. A normal, boring utility, it treats for almost double that, around 19. That huge gap, that's what you call the wildfire discount. Investors are demanding a half-off sale price to get paid for taking on that massive legal risk. Now, the fire risk is one thing, but I know what some of you are probably thinking. What about all that red ink on the cash flow statement? The company's burning through billions. And for a value investor, that's a huge red flag. But with a utility like this, you have to look a little deeper. You see, PG&E is in the middle of a massive build now, collect later cycle. They're pouring billions of dollars into the ground today to bury power lines and make the grid safer. But they don't get that money back tomorrow. Instead, regulators allow them to get all that money back, plus a nice profit from customers over the next 40 or 50 years. So that scary negative cash flow today is actually the very thing funding guaranteed profits for decades to come. So we have this great business with one giant, terrifying flaw. The big question is, can it be fixed? And that brings us to the catalysts, the things that could fundamentally rewrite the entire investment story here. And it really boils down to two main paths. The first is operational mitigation. This is the stuff the company can control, physically making its equipment safer so it doesn't start fires. The second path, and this is the big one, is legislative reform, where the state of California itself steps in and changes that inverse condemnation law. And let's give credit where it's due. On the operational front, they are making some serious progress. They've already buried over 1,200 miles of power lines. But more importantly, check this out.
They've now gone 3 years in a row without a major wildfire being caused by their equipment. That's a huge deal. It's the best evidence they have to go to Sacramento and say, hey, we've done our part. Now you need to do yours. But don't just take my word for it. The big dogs on Wall Street, guys like UBS and JP Morgan, are watching this very closely. They've been upgrading the stock, and they're not shy about why. They explicitly point to the growing possibility of legislative reform as the key reason. They see that as the real game changer, the one event that could unlock the stock's true value.
Okay, so that's the main story, risk versus reform. But now let's talk about a wild card, a hidden tailwind that most people aren't even factoring in yet, a growth kicker that could pour gasoline on the fire, in a good way this time. And it's all about the AI boom. What's the one thing that AI is absolutely starving for? Power, just a mind-boggling amount of electricity. And get this, PG&E currently has a pipeline of more than 10 gigawatts of new data center projects asking to plug into their grid. That is a level of demand growth that the utility industry just hasn't seen in decades. It's staggering.
And here's where it all clicks into place. Remember our build now, collect later cycle? Well, to serve all these new data centers, PG&E has to invest billions more in building out their grid. And as we know, every single one of those dollars gets added to their rate base, which directly leads to, you guessed it, more guaranteed profits. The AI boom is a massive, unexpected accelerator for their entire business model.
Okay, we've covered a lot of ground, so let's put all the pieces together and try to land this plane. What is the final verdict on PG&E as an investment right now? If we run this through a kind of classic Buffett-style checklist, you see the paradox in black and white. A durable competitive advantage? Pass, it's a monopoly. Predictable earnings? Pass, that's the whole regulated model. Good price? Pass, it's clearly discounted. But then you look at things like return on capital and the strength of the balance sheet, and you get two big fails. That's where you see the strain from all the spending and that ever-present liability risk. So what's the reward for taking on all this complexity and risk? Well, this number is a good way to think about it. The market is offering you what value investors call a margin of safety of almost 18%. Think of it as the discount you're getting, the extra potential return you're being paid for being willing to shoulder the uncertainty of that wildfire liability. And this is maybe the most important takeaway of all. Let's be really clear. PG&E is not your grandfather's sleepy, boring utility stock right now. Not even close. It is a special situation investment. The entire thesis, the whole reason you'd buy this today, hinges on a single external event, a legislative catalyst that could completely change the company's future. I think this quote just nails it perfectly. You have to look past the current mess, past the scary headlines and the negative cash flow, and see the business that's underneath. Because if, and it's still a big if, lawmakers in California change that liability framework, this thing transforms into a cash-gushing machine almost overnight.
Which leaves us with the final question, the one you have to ask yourself. The potential upside here is huge, maybe a 30 to 40% jump in the stock price if that legislation passes. But that reward is completely dependent on the whims of politicians. So the question is that reward big enough to justify the risk and the wait?